New tax introduced on corporations that are doing share repurchases, share buybacks, but is it actually curbing those buybacks and that behavior? I've got that info and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Had a suggestion a while ago to do a video on share repurchases and the impact on the stock price, and also Congress introducing a new excise tax that was to take place starting 1/1 of 2023 on share buybacks. But I've been waiting to see because, the question is, will 1% really matter and will it influence things? And here's the thing, as an investor, if you invest in mutual funds, invest in ETFs, invest in the stock market at all, repurchases have played a big role in your performance over the past, several decades. And I don't have all the data to show here, but when a company is making profits, they can take those profits and make capital purchases or, to buy a building and so on. And some of that is depreciated over time. Or they can retain it as capital within the company, but then you get, money that's not really working hard for you, right? So then there's really a couple other choices. As companies, you can pay that cash out as a dividend. And when you do that, it's sort of subject to this double taxation, right? Where the receiver of the dividend has to pay tax on it as well as that corporation. Or the corporation could choose to use those dollars and repurchase some of their shares out in the open market. And when they do that, that reduces the number of shares outstanding and actually helps support the stock price and even push it higher depending on how much repurchase is done. There's been lots of articles about how much repurchases Apple has done over the years. And of course, they've had so much profit and have managed so much cash that using their cash, excess cash, to repurchase shares to help the stock price and be wise with their cash has made a lot of sense. This is a common corporate practice, but the White House, and let's say Congress, has taken aim at this, saying, well, there's too much of it and we want to curb it. So starting 1/1 of 2023, there's a new 1% excise tax on share purchases meant to curb this behavior and have it not be so excessive. Well, guys, January is over. We're into February, mid-February. Has it worked? No, January saw a significant increase in the amount of share repurchases, share buybacks, than the January before. Even though there's this 1% excise tax, and this even caused the president during the State of the Union to share, we should increase that tax to 4%. So listen, why has this not created this detraction from or a slowdown in these share repurchases? Well, there's a few reasons for it. One, and the common belief is 1% tax is not going to make an enormous net difference, right? So right now you've got a 1% tax. That doesn't really mean anything, doesn't equate to a lot. Well, I can see that to some degree, but listen, I'm assuming no one wants to pay any extra tax, anything more than their fair share. So even 1% might be an irritant, even if it doesn't fully dissuade behavior. I think another reason is that, well, that's why I went through those choices of what a company can do with their cash. If you pay that cash out as a dividend, you're going to have to, the shareholders, which are oftentimes, the C-suite executives as well, the key employees are typically owners. They own a decent amount of stock and they're compensated with stock as well. And so when you pay out a dividend, those shareholders have to report that dividend as taxable income. And it shows up as ordinary income tax, meaning they've got to pay, their ordinary tax rate, 22, 24, 32% on it, right? And so a 1% tax on share buybacks versus paying more in dividends and having more of that money subject to ordinary income tax rates, well, 1% is better than paying a dividend, right? And the argument is, and the math would support this as well, that, well, if a share buyback helps the stock price be stable and even appreciate more over time, whenever you sell your shares, that growth you have to pay capital gains on versus a dividend you have to pay ordinary income on. So there's an advantage there. Therefore, a 1% tax really doesn't dissuade that behavior. So those are the two primary reasons why corporate repurchases, share repurchases haven't been deterred. But a couple other reasons. I mean, number one, the tax is on net repurchases, and a lot of companies are issuing shares as part of new shares as part of compensation. And so if a company repurchases the same amount of shares as they issue, then there's a net no change, and therefore there's no 1% excess or 1% excise tax on the share repurchases because they issued that many more as well. So maybe companies are just looking at this saying, well, we're issuing a lot of new shares as compensation to encourage our executives to navigate this challenging economic climate, and we're willing to repurchase shares to offset that. That may be the case. And then you've also got to consider that a year ago, yes, the S&P 500 had an awful January, one of the worst Januaries on record, and yet the S&P 500 was still in the 4,500 range or around there. Today, after a rebound, we're around 4,100. So overall, stock prices, and obviously this depends on each individual company, but they're depressed compared to where they were a year ago, last January. So to look and say, well, companies are buying more shares today than they did last January, well, the stock might be more attractive at this. They might be able to buy more shares at this lower rate or at a lower price, and therefore help stabilize their stock and help it have appreciation more in the future. So that's a little bit about the new tax for not for individuals, not that individuals pay, but for corporations that publicly traded corporations pay, how that could influence the stock market and stock price. To me, 1%, a 1% tax that was introduced this year hasn't deterred it at all. The data suggests whether because the 1% isn't big enough or other factors that I just shared, it really, it's significantly more this January than it was last January. What's your overall investment strategy? If this changes, if the White House and Congress gets what they want and increases this tax to 4%, does that curb things? All of it boils down to what's your investment risk tolerance? What's your investment strategy and risk tolerance? Are you taking the right level of risk for your situation? Work with your CFP on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with K, wisemoneyshow.com. You can find us there as well, or send us an email, info@Korhorn.com. All right, there you have it. Go out and take your next wise step in your financial life.